Imagine if half of a major global currency vanished overnight, not through theft, not through a catastrophic hack, but by a single intentional act, an erasure that would ripple through every market, every portfolio, and every conversation about money. The world's financial heart would skip a beat, and the aftershocks would be felt everywhere. This wasn't a heist. It was a possibility whispered in the dark corners of the internet, an idea that, if true, could change the fate of millions overnight. The rumor began as a single wild post. Ripple might burn a massive portion of its XRP supply. At first, it seemed like just another outlandish theory, lost in the noise of online speculation. But what started as fringe speculation quickly gripped the crypto world. Analysts and traders, always on the lookout for the next big move, found themselves unable to ignore its plausibility. The story spread like wildfire, igniting debates and frantic calculations. Every Ripple executive's tweet was scrutinized, every blog post dissected for hidden clues. The community pored over official statements, searching for any hint of confirmation or denial. The absence of denial from Ripple only fueled the fire, turning whispers into a frenzy. Social media exploded with theories, and the rumor took on a life of its own. Trading volumes spiked as the market began trading not just XRP but the story itself. Every tick of the chart was a reaction to the rumor, not reality. The rumor became a self-fulfilling prophecy, driving speculation and volatility to new heights. Uncertainty reigned, and fortunes were made and lost in minutes. The community split. XRP holders dreamed of a supply shock that could send prices soaring, while skeptics warned of manipulation and chaos. Arguments raged in forums and group chats, dividing friends and foes alike. The stage was set. The world waited, breath held, for Ripple to confirm or crush the wildest rumor in crypto history, a moment that could redefine trust, value, and the very future of digital money. In our fictional timeline, Ripple's leadership faced mounting criticism over its massive XRP holdings. The solution, a radical proposal, burn 50 billion XRP, half the total supply. Fierce debate erupted. Finance warned of a multi-billion-dollar loss. Legal teams scrambled over regulatory risks. But the vision was clear: to shed the image of centralization and prove XRP's neutrality. Burning half the supply would be a public commitment to decentralization and trust. The gamble was enormous, but the leadership believed the sacrifice would unlock greater value for all. With the plan set, Ripple prepared for a move that would redefine its future. The countdown to the burn began. To truly grasp Ripple's fictional move, it's essential to first understand the concept of scarcity in economics and how it applies to digital assets. In both traditional and crypto markets, scarcity is a powerful force. When something becomes harder to obtain, its perceived value often rises. With fewer tokens in circulation, each remaining token can become more valuable, simply because there are less of them available for people to buy, sell, or hold. Think of a token burn like an artist destroying half their paintings. Suddenly, the surviving pieces are much rarer, and as a result, more precious to collectors and fans. In the world of crypto, burning tokens means sending them to a special address that no one can access or control, effectively removing those tokens from the supply forever. This process is completely public, transparent, and irreversible. Anyone can verify the burn on the blockchain, and the reduction in supply happens instantly. The psychological effect on the market is huge. When people realize that tokens are suddenly much scarcer, it can trigger FOMO, fear of missing out, and rapidly shift market dynamics as traders rush to buy before prices rise. Unlike tokens that are simply locked away and could be released later, burned tokens are permanently destroyed. There's no way to bring them back, making the reduction in supply absolute. Imagine if a central bank decided to incinerate half of its currency overnight. The remaining bills would instantly become much more valuable, and the entire economy would feel the impact. Ripple's fictional token burn was designed to unleash this kind of shock on the market, creating a dramatic shift in how people perceive and value the token. The result? A new era of digital scarcity, where every remaining token becomes a coveted asset in the eyes of investors and collectors alike. The day everyone had been waiting for finally arrived. Ripple's highly anticipated live-streamed announcement drew in millions of viewers from every corner of the globe. Crypto enthusiasts, investors, and skeptics alike gathered around their screens, eager to witness what would become a defining moment in digital currency history. The CEO took the stage, addressing swirling rumors with a calm but serious tone. Then, in a move that no one could have predicted, he dropped the bombshell. Ripple had just burned 50 billion XRP tokens, a staggering amount that left the audience in disbelief. The entire transaction was broadcast live for the world to see, with tokens being sent to the infamous XRP black hole address. The digital animation made it clear, these tokens were gone forever. The act was irreversible, verifiable, and complete. Half of all existing XRP vanished in a matter of seconds. The blockchain confirmed the burn, leaving no room for doubt or reversal. The CEO was quick to clarify the motivation behind this unprecedented move. He insisted that this was about true decentralization, not about manipulating the price or creating artificial scarcity. From that moment on, he declared, the future of XRP would be shaped by its global community, millions of holders, developers, and believers around the world. As the stream ended, a stunned silence swept across the crypto world. People everywhere struggled to process what they had just witnessed. Instantly, social media platforms exploded with reactions, hot takes, and wild speculation. Trading charts shot upward as traders scrambled to respond to the news. In less than 15 minutes, the entire digital asset landscape had been transformed. The ripple effects were immediate and dramatic. The shockwaves from Ripple's announcement were only just beginning to spread, promising even more upheaval in the days to come. Crypto history had just turned a page, and a new era was underway. The market erupted. XRP's price soared as buy orders flooded in. Analysts scrambled to explain the unprecedented supply shock. The narrative flipped. XRP was now a scarce digital asset, not a centralized coin. The XRP community celebrated vindication, while regulators were blindsided. Questions swirled. Was this legal? Was it market manipulation or visionary stewardship? Ripple's move forced regulators and institutions to confront a new crypto reality. The burn was more than a financial event. It was a catalyst for global debate. In the aftermath, XRP's price stabilized at a higher plateau, underpinned by scarcity. Institutions, once wary, now saw XRP as a decentralized, reliable asset. Major banks launched pilot programs, citing Ripple's bold commitment. The burn shifted XRP's narrative from speculation to real-world utility. Ripple could finally focus on its technology, not defending its token supply. The market matured, attracting long-term investors and reducing volatility. XRP became a core part of global finance, its value driven by adoption, not hype. The burn marked a clear before and after in crypto history. This fictional XRP burn is a thought experiment with real lessons. It shows the power of engineered scarcity and the importance of tokenomics. Narrative shapes markets. Bold actions can rewrite a project's destiny. Perception matters as much as technology. Trust and decentralization are priceless. The story highlights the tension between innovation and regulation. Major moves force regulators to adapt, shaping the industry's future. Crypto's evolution is driven by bold ideas and what-if scenarios. Exploring these helps us understand the forces at play in digital finance. Remember, this is fiction, not financial advice. Always do your own research before investing.